So, Jim, where are you today? I know David's at the homestead in Louisville.
I'm in Miami. I'm in
Miami.
Miami. Yeah, I was in Toronto and which was freezing, and I need to unthaw before I go to San Diego. San Diego's been cold, so it's like 80 degrees here. It's kind of crazy.
We got severe storms coming all night tonight in the high risk area, tornadoes and all that stuff. So I'll kind of watch that
Hey,
here.
Rob, just FYI, I'm serving as the interim CEO. I've been demoted, and David Kittle is the chairman until we find a replacement for both of us. So,
For both
David,
of
is
you?
that also a demotion?
Yeah,
demotion. I don't know. Do you want? I mean, am I going to Mangoes? No, I'm not going to Mangoes. Do you want to be the chairman, Rob? I mean, it's it doesn't pay anything. It get a lot of headache.
Heavy is the head that wears the crown. What's that saying?
You just nailed it.
You also that head usually gets chopped off too. So
your hair just falls out.
Hey.
Hey,
All right.
hey.
I think it's time I think, Tom, it's time for you to crank things up.
Breaking it up as we close out the first quarter and the month of March today. Welcome everybody into the latest edition of The Rundown. As always, our esteemed co-host, Rob Crispin. I'm Tom Gallucci here, and a pair of hopefully very familiar faces to this audience today. We have joining us in the interim CEO of the Mortgage Collaborative, Jim Park, as well as the interim chairman of the Mortgage Collaborative, David Kittle. And gentlemen, I know you are active listeners and viewers of the show. Welcome into the co-host seats.
Yeah, good. Thanks, Tom. Good to be here.
I think all it means, David, when you're an interim, it just means you have zero power and influence. And we're just kind of warming up the seat for the next person to show up. So thanks for letting us in.
Yeah, good to be here.
That's what I tell all my friends. These two are at my beckoning call these days. But as we get into today's episode, tomorrow is April Fool's, so thought it'd be fun, as we always want to leave our audience with some informative takeaways dropped in the chat, and certainly encourage our audience to engage with us in the chat. Just maybe you've had a favorite April Fool's prank or joke you've pulled off over the years to a significant other, a loved one, a coworker. We'll certainly love you to share there. I'll give a personal favorite of mine. This probably goes back to college days, but we used to take a 3-hole punch, and some of our younger audience members may not be familiar with that, but basically a device for when you used to have to put paper into a binder for college courses. And you go through an entire rung of paper, you collect all the paper chads that you pull out of there, and you go into a friend's car and you dump those chads into the air vents, and then you make sure to turn the air conditioning on high so that when next time they step into the car, they have a very fun confetti display to start their day. Nothing
horrible.
That's quite a prank.
You're bored this weekend, something to try.
My most memorable one was where actually I was a kid and I was getting ready for school in the kitchen, and my dad called from the cannery. He was a cannery and he was a cannery foreman in later life, and he called to say that he'd heard on the radio that school was canceled that day, which of course it wasn't, but I got very excited. And then he said, April Fools, get to school. I don't know why that always stuck out in my head, but that was
Hey, Rob, your dad worked at a cannery?
And later, yeah, he retired. He was in San Jose.
You might be the first person I've known who's had a dad who's worked at a cannery. It's like a Steinbeck novel. I've always thought you were very poetic.
Well, it's I grew up working in the cannery. I mean, that's my kid. My cronies were off in McDonald's making, $3 or whatever an hour, and I was in the cannery earning 6 or 8. So it's a good deal, but canneries are
Grapes
interesting
are at-
places.
Grapes Raft is actually based off of the Crispin family story. And,
Right.
you guys made your
Grapes
way
of
to
Wrath.
California, right?
Yeah, so how about this, guys? Quickly,
Anyway.
mine was back when you used to take on pink message notes, you'd leave a message for somebody years ago and handwrite the phone number down. Is for my regional manager back in the 80s. His name was Bruce Culbreth. 3 years in a row. He would fall for the same number, different names. Please call Mr. Bear, BEHR, and the number would be for the Louisville Zoo. And I'd stand outside and listen to him dial the number and ask for Mr. Bear. It's dumb, but he'd do it. Hello. Oh, it must be April Fool's. Well, thank you very much. And he'd hang up. How dumb, but there's my joke.
There you go.
There you go for bad memories.
Well, guys, let's go ahead.
I don't really have one. I mean, I don't know. I'll think about it by the end of the show. Tom, you can't
There
give
you
me these
go.
things. You got to let me research because I'm very old. I have to go back into the, to my memory bank and sort of really search through it. So I'll have something by the end of it.
The authenticity of the show, I got to put you on the spot every once in a while. And maybe if we have time at the end to rattle through some of the pranks that have been done over the years, already filling up our chat from our audience. I'm loving it.
There's some very mean people among this group.
Mortgage industry will do that to you, but we want to get into today's rundown episode here. I think Jim, David, with the unique opportunity to have you both joining us on this episode, definitely want to take the opportunity to kind of reflect on maybe some of the things that you guys may be hearing of late, or specifically coming out of our San Diego member conference, from the 260 plus lender members, community banks, credit unions, IMBs alike that make up our membership. As I think that could be great intel for the audience too, as to what's kind of top of mind in the lending community. And Rob and I may have some specific questions, but I'm curious if anything jumps out to you top of mind.
Jim, you want to go?
Yeah, sure. You know what? The conference down in San Diego was amazing. One, because I didn't have to fly anywhere. I live not too far from there. But it was great to see everyone. Obviously, it's a tough time for folks. And, to make a commitment to come out and spend 3-4 days is a big deal nowadays. And, we had some really amazing dialogue. As you know, with our conferences, we have a lot of these smaller discussions where people can really get into the weeds in terms of their business and what they do. And I do think there is this little bit of exhaustion around, the bad news, right? We've lived it for a year and a half now. The latest round of bad news around, 99 basis point loss in the last quarter, all of that stuff. I mean, it just keeps adding on top of each other. But I do think people want to look forward. I think people are looking to, think about how do they survive this year and how do they build for next year. And, a lot of discussion around kind of rethinking their tech stack, reducing their cost structure. I don't know how you can originate loans without an LL, but I think some people would love to do that and just to reduce the cost. But those are sort of the things that are top of mind for people. They need to manage through this year, and it's going to be hard, but people are doing it. They're sharing best practices around those things. So I'm optimistic about it. We can kind of sit here and look at all the bad news and think about how horrendous another, second bad year. But, we came out of 2 crazy year of just best years ever. We didn't expect 2 bad years, equally bad, but, that's what we have. But I think this industry is resilient. I mean, guys like David, who's been around for a very long time, and Rob, not as long as David, you've seen the cycle, right? We've all sort of seen the cycle, and we make it through the other side. So I feel optimistic about where we're at.
Yeah, so what would I add to that? Down to specifics a little bit, I think as contracts come up, a couple of things I heard in San Diego, and those are good points, Jim. Contracts as they come up on your LOS renewals, You know, are there vendors who they're using holding to what it was before, or will they renegotiate at this point? Tough things to get through right now that they won't renegotiate. There's a lot of that out there that they look at it because it's very expensive as they've had to, you know, cut down. They have so many user seats. That's one thing. You mentioned it, you know, kind of tongue in cheek, but I've had 3 lending companies over the years. I looked back a couple of months ago, and this is, from what I could remember, the 7th major correction up or down that I've had in my 47 years in the business. So it's about every 7 or 8 years, whatever that works out to be.
David, you started out when you were 1. Is that what happened?
2.
Two. Oh, okay.
Yeah.
All right.
But, you know, going into my 47th year, and every one of them is the same, and every one of them is different. The last one we went through was to me, my opinion, was all credit. I think Rob would agree with that. And the one we're going through now, I think, is mostly policy coming out of DC around there. So I would go back and finish with this comment and say, you know, the 2 most expensive things if you're an owner that you have to pay for is technology and the origination of the loan. And LO cost is high, and that's something that needs to be looked at and addressed through this tough time. And you could maybe redo it, but that's a tough cost for people who own independent mortgage companies right now. So it's something that really needs to be looked at.
Yeah, I mean, couldn't agree more, David, and certainly would welcome the audience to, you know, you guys are coming across creative strategies on how you're thinking outside the box to potentially reduce origination costs while giving away your secret sauce. Certainly love to get that commentary going, and maybe we can reflect on some of that feedback. But Rob, I'll let you go. Say
Well, I was going to ask David or Jim, obviously the LO comp comes up as a continued issue because as we saw during the pandemic, those 2020, 2021, basically cramming 4 to 5 years of production into those 2 years, 4 to 5 years of income or compensation into those couple of years for many AEs and LOs. And the LO expense, obviously, for an independent mortgage bank is very high. Banks and credit unions have much less per loan expense just because of the way things are structured. But are you hearing any, and this comes up like every couple months or every business cycle or every 3 months or 6 months or whatever, gee, when are they going to start to cut LO comp? I personally haven't seen any company, proudly announce in the Chrisman commentary, we're cutting LO comp and away we go, come work for us. But what I have seen are companies that will say they will kind of nip at the edges of LO comp based on, say, lead source or channel, or whether you go out and hunt and kill your own loan or whether it's brought to you through the servicing portfolio and so forth. Have either of you seen any independent mortgage banking members actually tweak their compensation to try to lower their costs?
Yes. Without giving names, and I don't think that's appropriate, but they have, and they had to sit down. We always talk about team all the way from top to bottom, from secondary to funding, processing, origination, all of it, underwriting. If it's a total team, then everybody has to look at themselves in this particular market and say, do I take a little less here to save my staff? You can argue chicken and the egg all day long. You got nothing to process if I don't produce it. However, if your company shuts down or they have to continue to lay off staff in this market, how many rifts do they have to go through? So you've really got to think, do you enjoy where you work? Do you love your benefits and the people you work with? Then you really have to look at that and go to your manager and sit down and say, short term, maybe this is something that I can contribute. Still can make enough to eat on. And but there have been, and I'll throw this out too. I know of an $8 billion producer a year and a half ago that's gone right now. Gone. And they're gone because it was too heavy on the production side. Didn't keep enough back. So and that was a management decision. It was a bad management decision.
So is that,
You know,
I would
it's
imagine that's a very
yeah.
tough discussion to have with the staff. Hey, we're going to do this. I've heard that management try to, one technique is to say, okay, we're going to move part of your compensation into marketing or training or pricing. And you know what? Everybody's got to sacrifice. Obviously the company has sacrificed. We're making less money, and people have had their salaries cut back, but we're going to take your compensation, Mr. or Mrs. AELO, and move it into some other area, which hopefully gets you more business going down the line. So David or Jim, have you heard that technique being used?
Yeah, I think people have, in our discussion, in our sort of collabs and other things that we do, kind of lender roundtables, these discussions obviously happen. People are talking about a lot of these different techniques to reduce the cost structure. But the thing is this, I think the reality is this. I mean, for so long, it's hard, we say, hey, we need to control our low comps and all those things. And people say it, been talking about it forever, but they chase after the volume because they think that's the solution, right? And the fact, if you look at the number right now, that solution is not volume, right? Because the more production you have, more likely that you're going to lose money. And so if that's the reality, then I think we have to all kind of sit back and say, okay, what's fair compensation for people in this kind of business? I know some people have sort of tried different channels, consumer direct to kind of get around, paying LOs and all that. But that's the volume is been sort of our demise to some extent, right? And I think we have to kind of get a better handle on the cost structure of the manufacturing process overall. And that's what really I think a lot of people are talking about right now. You can't create volume and get to profitability for most people if the numbers are correct, right? And I don't see that number changing anytime soon.
Yeah, I mean, you're spot on, Jim. I think the MBA Q4 mortgage banking report numbers, were very sobering out there to the industry, kind of confirming a lot of what we heard. Average loan loss, 2,800 per file in Q4, only 1 in 4 mortgage companies profitable down the stretch of last year. To your point, it is a golden opportunity to really review that compensation model, and some great commentary in the chat. Joe Carleone, CFPB open commentary period on LO comp rules imposed by Dodd-Frank. So a good opportunity right now to weigh in on that. Good friend of the network, Victoria DeLuz. PLs can be the demise of some companies. And then even along those lines, I got to give a shout out to Guy Schwartz, who co-hosted with us last week. Guy, I tried to grow some chops in honor of you for today's episode, but the beard didn't fill in as quickly as the burns did. But he added in the chat just asking if anybody was willing to chime in around the lack of transparency as it relates to pricing for IMBs right now.
Pricing what?
Pricing for IMBs in particular.
Well, darn it, Guy. I'm not going to step on Mike Blake's foot in terms of, I know you're with Fairway, and Mike, I know Mike very well. I guess I don't know what he means by transparency. It's, the company has to make money. Everybody has to make money. Obviously, the difference between, say, a broker and a banker is a broker probably isn't setting aside much money in terms of future buyback, handling legal issues, handling buybacks and so forth. Whereas an independent mortgage bank, like a Fairway or a Rocket or UW, whoever, has to set aside a reserve, because you know what, if an agency buyback comes back and that, Fannie Mae or Freddie Mac wants ABC Mortgage to buy back a 3% loan because the underwriter missed some, it was a pension instead of a bonus, or a bonus instead of a pension, or whatever it was, or recurring versus non-recurring, whatever. If they are forced with buying back a $400,000 3% loan, first of all, they've got to have the $400,000, and then they've got to go market that 3% loan in a 6% world they're going to get 85 or 90 cents on the dollar. So independent mortgage banks are very cognizant of that. And so in terms of pricing and the P&L and what is built into an independent mortgage bank's price, a fair chunk of it is dealing with potential buybacks and legal costs. But then you have the whole overhead situation. So the loan, in terms of pricing, what goes out on the rate sheet, capital markets people are meeting all the time with owners and managers and saying, okay, what kind of margin do we want? Because my goal as a capital markets person is to protect that margin, is not to make a bunch of money for the company, because I'm not going to be taking risks with the locked pipeline or the hedged position. My job is to protect whatever margin we are building into this and try to pick up, let's say the mandatory versus best effort spread. But the pricing itself is you take the MBS and you take the value of the servicing, and then you add in your overhead, and you add in what kind of profit margin you want in there and where you want to be in a competitive position compared to other places in the market or other companies that are in your market, and spit it out and see what happens. It's not exactly rocket science, and I don't think independent mortgage bank capital markets people are always trying to pull the wool over loan officers' eyes in terms of pricing. But it's pretty straightforward.
So think about this. I agree with Rob. If one of the things I think we're dealing with in the industry right now is if you've only been in the business for 15 years, which is a long time, you've never seen anything mostly but great times and low rates. And, back when I started, it was up and down all over the place all the time. Rates went up, they went down, went through refinance, went as high as 18.5% in the early 80s, if you can think about that for a second. And you're doing cartwheels when it went to 13%. When it broke 10, everybody, it was great. But you're dealing with people right now, a lot in our business, that have never seen this big of a correction. So it's tough to deal with, to say, well, why should I have to change what I do? I'll finish with this one point. Consult with a company, and they went to staff, not sales staff, but their actual staff on salary, and offered a bunch of them, keep your job if you take a 15 to 18% pay cut. All over it. Didn't want to lose their job. And that's the reality of it. If you put it in that context, people are willing, because where else do they go right now? And so those are the discussions that are being had internally. And so, but to Rob's point, I think there's plenty of transparency out there in pricing. You got to look at what your competition is doing and what you have behind you and what the overhead is. And as an owner of an IMB, you got to be willing to have those discussions with your staff and your sales staff and your fixed costs as well.
You're watching the rundown.
It's
Oh,
sorry, sorry, Tom. Go ahead.
Gotta get the plug in here. Just some additional commentary from the chat. This is out to the entire audience if you're seeing the same, but some conjecture about companies requiring loan officers to say that a loan is an internal lead loan and get paid less to get a price exception. Open-ended question if anybody's seeing that out there. And then on the buybacks front, just some commentary seeing non-curable buybacks because borrower changed jobs, and then the day the loan funded, that those suck and you got to be prepared for those. And then Victoria chiming in as well to Rob's point, not just about pricing transparency, but about complete company transparency, and that to understand pricing, to understand a company's complete expense structure, in addition to the market desired profit margins, mortgage companies are supposed to be profitable in most markets, at least.
It's not, it's a manufacturing plant mentality. And if some manufacturing plant has a lower cost to produce a widget, because mortgages are a commodity, if your competitor is paying their loan officers less, if you're competing against a bank or a credit union where the loan officers might make $4,000 a month, rain or shine, and you still want your 1.5 comp, or you're dealing with a broker shop that doesn't have underwriters or doctorars or processors or funders or whatever capital markets people you're dealing with against fighting, not fighting, competing against a broker that doesn't have that kind of overhead. Yeah, you're going to have pricing discrepancies all over the place, and that's nothing's really changed in the last 2 or 3 or 4 decades in terms of that. Who's ever out there producing those loans at the lowest cost, selling them, they might be selling those loans at the same price larger companies sell them into the mortgage-backed security market. Maybe the servicing is worth about the same, but if they can produce that loan for $1,000 less or $2,000 less, they can put that in their price. It's not complicated.
So it's
All right,
not
I'll
all
get off my stump now. We should talk about something. We should talk about something more fun.
That's what I was gonna say. It's not all doom and gloom in the mortgage market.
Something
You guys are
more fun,
dragging
like
us
the
down.
CFPB. What's
Right.
that?
Well, I
Jim?
mean, it is crazy. I mean, we've been talking about this, the manufacturing costs moving up over, and we think at some point it's just going to stop, but it just hasn't. And you think technology and all this stuff is going to actually create more cost savings, efficiencies, and all that, but it hasn't done it for the industry yet. But I do think a lot of our members, and this is what I see, is that I see so many of our members engaging with many of our partners more so than ever before. They have more time now to do it too. So, but they are rethinking their tech stack. They're rethinking how they kind of really fine tune their manufacturing process. So I hope this period, while it's really stinks, it sucks, I do think it is a time for a lot of folks to kind of re-engineer their process, create more efficiencies. As long as, FHFA doesn't throw out things like, loan level pricing adjustments on DTI and stuff like that, where we have to kind of rejigger the whole process again. But hopefully this will end with a more efficient process when it's all said and done. That's my hope.
I think, going back to, I think, a point David made earlier in terms of, the costs and so forth, the cost, if you have a contract with a vendor and you have to pay that vendor, I'm going to make up numbers here, but if you're paying that vendor, $100 a month and you're producing 100 loans a month, the cost of that relationship is $1 a loan. When you're only producing 20 loans a month and that vendor is still charging you $100 set fee a month, suddenly you're in it for $5 a loan. And there are some companies that are willing to take that $100 a month and ratchet it down. And other companies have a reputation for saying, sorry, you're going to pay us $100 a month, whether you produce 1,000 loans or 1 loan. And some of those vendor relationships are very difficult for lenders to deal with. And it's causing those companies, those lenders, to look elsewhere for their services. But in some cases, they may have signed a contract with a vendor that goes out 2 or 3 or 4 years at that $100 a month mark. And it can be a real problem. It can be a real problem.
Yeah, and I think that part of it
It's
is
something
also
we're
that
seeing out there with seat licenses. If that's the structure of your deal with a vendor, and now you've trimmed maybe 30-50% of your origination staff, but you're still on the hook for those same licenses. And if your provider is not willing to renegotiate, you've got to eat those in the cost to produce. Sorry, Jim.
Yeah, no, your point is exactly right. This is tough for everyone, right? Because there's a trickle down effect, right? So lenders are hurting, and now the vendor partners are hurting, right? Everyone, it just has this effect that's hitting the market overall. And our view is this, like within TMC, as you know, we've always been like, okay, we want our members to prosper, but also our vendor partners to prosper within it. Everyone's having to kind of deal with a very different environment now. People obviously are going through layoffs and all those. I don't want to be, because we've gone through several rounds of it already with people. We don't want to kind of belabor that issue, but I think we have to be sympathetic with each other in many ways in this process. Everyone's taking it to their chin, and we just need to make sure that we come out of this and support each other in a more effective way going forward. Doesn't mean you don't go in and renegotiate, these things, but but we have to sort of recognize that, you know, everyone's just really cutting costs to their bone, down to their bone. So
Yeah.
Well, happy Friday. Here on the rundown, still going.
hey, by the way,
Again,
cutting costs to the bones. By the way, we have cut our conference prices to the bones, and we're like, you know, it's not free, but it's but we already have more people registered. We have almost as many lenders registered for our Nashville conference coming up, Rob. Now this time you have to stay longer than one day. Than we had in almost all of San Diego. Like we have this tremendous number of people because we gave them a little discount. So I think it's discounts over, right? If you haven't signed up, you're kind of out of luck. But
I would have stayed longer, Jim, except David had contacted me offline. I think I'm free to announce this now. And David said, look, you know, we're trying to tighten our belt here at TMC to help our members and vendor partners. And could you not like stay overnight? Because the hotel was like $350. I don't know what the hotel room was. And I said, for you, David, I will do that. I'll help pass those savings along to the TMC family.
we had taco trucks for everyone because we had to cut costs. So you know, and
Rob
so we
Crispin's a team player, let me just tell you.
right. Ultimate man of the people, Rob Crispin. We appreciate
I thought you were going to Coachella and rock out with the rest of the folks. I thought that's where you're going.
I headed north in a rented Toyota Corolla up to a Jimmy Buffett concert in Indian Wells near Palm Springs.
Nice.
close enough at Coachella.
Well,
Well,
Yeah.
All right. Okay.
Speaking of-
Rob is a parrot head. So official.
Speaking of
Official.
concerts, Mr. Chrisman, what are you going to be doing this weekend?
Tomorrow night I will be walking over to Madison Square Garden and seeing Bruce Springsteen with my son Robbie.
Awesome.
Springsteen.
So-
what the ultimate Christmas gift from Robbie.
Yeah, no, it's very kind of him. Very nice.
Well, guys,
Anyway,
as
what
we've
are you
said,
doing this weekend?
what am I doing?
Yeah, what are you doing this weekend?
Not a whole lot. I'm gonna hang out at home and get started with football practice for my son. He's on the Patriots this season in flag, so I've got to get me and all the coaches a mock cutoff sleeve Bill Belichick hoodie for the crew to be in line with the theme. But that's it. I don't live an exciting life. Jim, David, you probably have more exciting going on in your world tonight.
Well, you know what I'm doing? It's kind of weird, but I'm right now. I'm in Miami at an NFT week event. I am all about the NFT crypto, so that's what
I
I'm
thought they
doing.
died with crypto. Is the NFTs are still going strong?
Well, it's pretty much close to dead, but if you look at Ethereum and some of the, Bitcoin, it didn't really crash like everyone else thought it would. You know, that's stayed pretty stable. So there's a whole new economy being built around the whole metaverse, NFT, crypto. And so I'm just checking it out. You know, I'm trying to put TMC in the metaverse, man. So that's the goal. So we don't literally have to show up anywhere. We just kind of like, you know, zoom in from Rob's house, wherever
Are
his
you
house
out there
is.
pushing Kittle currency?
Kittle currency crashed. That crashed a while ago. So
So Tom, I've got tea times and teenies this weekend. So tea time Saturday and Sunday and maybe a martini mixed in there. And that's about it. Not very exciting.
That's a staple weekend in the Kittle world. So before we wrap for the weekend, again, not all doom and gloom. We saw this week through NBA apps up for the fourth straight consecutive week, although 3%, so marginal gains there, as well as from NAR's update, home sales up for the third straight month. Again, 0.8% February over January, still lagging 21% from last year, but you know, spring is springing. Hopefully, some positive vibes with the buying season coming up here. But Jim, David, as we close out, you know, anything you guys want to reflect on as far as what we're doing with the Mortgage Collaborative in the spring and summer quarters that gets you excited or should get our members and partners excited?
yeah, I mean, we got a lot of great things happening. You know, the work of the organization continues, right? A lot of changes. As you mentioned, you know, Tom, both David and I are interim. right? So we're here for a little bit of time, kind of making sure that the boat continues to move in the right direction. We are lucky that our team is amazing, and so they're doing their thing, engaging our members, engaging our partners. Home sale and all those things are, it feels it's sort of regional. I think as I think real estate is local, so it's really local, very local. And like San Diego, my home probably dropped price by quite a bit. I think David Kittle in Louisville, maybe not. Like you guys might be okay.
But we saw
Rob
that,
Chris,
Jim, in some of the
Rob,
stats
Rob
this
Chrisman,
week.
Rob Chrisman has houses literally everywhere. So I don't know whether you're doing well or not, Rob, but I think it's also, that will, I think the markets that saw a huge boom during the whole pandemic and all that stuff definitely are seeing a downturn. Other markets that have been more stable, job creative states, they're doing great. They're still doing great. So it's gonna be all up and down. But I think from our end, all we can do is this, recognizing that purchase money is still most important part of the business currently. Refi, who knows when that's gonna show up. When it does, it'll show up. We may show up with a vengeance, but right now it's a purchase money business. It's all about kind of acquiring new business relationships and realtor relationships and all that kind of stuff. And so, for instance, at TMC, we've just recently launched a TMCU. We have four really dynamic programs in place. We have several more coming up. A lot of it is around business development, acquiring new relationship, and all of those things. We think that kind of stuff is going to resonate really well for our membership base and just for the market overall. So our goal is to keep, educating people, keep providing support in this kind of environment. So, despite the doom and gloom, we're still optimistic that, what we're doing is going to continue to help our members and our partners. So, yeah. And by the way, just Nashville is David's second favorite city. So we just want to make sure everyone shows up to that venue.
Yeah,
David
how
will
can I-
ensure that the quality of bourbon is strong in Nashville.
I
Yeah,
don't think he calls it bourbon in Nashville. Do you, David?
No, they don't call it bourbon down there. It's whiskey when you go just a little farther south. Remember, all bourbon is whiskey, all whiskey is not bourbon. So just remember that. So it's but I couldn't add anything to what Jim said. TMCU, we're really proud of that, what Stacy's doing with it. That's something you should really look into. And of course, coming to Nashville, it's going to be a blowout conference. And a lot of people are going to show up, and people love going there. So just on top of what Jim said, to reiterate it, sign up now.
Well, some closing commentary in the chat. Andrew Young says, Jim, save your money. The metaverse is dying. Guy Schwartz says, invest in Beanie Babies and tulips. Those are tried and true. And yeah,
I do have a whole stack of Beanie Babies at home. My kids loved it way back when. So I'm going to put that back on the market. But by the way, metaverse, you don't know, right? We don't know. So we people used to say the same thing about people grabbing URLs, right? And just names on the internet. Like, why are you grabbing all that, right? Those people are retired on a yacht somewhere. So I think you don't know where the market goes. I do think this one thing in 2021, if you look at first-time buyers in 2021, I know it just sort of feels like a lifetime ago, about 13% of first-time buyers in 2021 use crypto towards their down payment. And that number and the crypto users have not declined. Now they're not worth as much anymore, but that's not declining in terms of number of people. And that's going to probably move up. And so my guess is, yeah, it may not have an impact today, but it will change in the years to come. And so, it might not be quite as, powerful as Beanie Babies or tulips, but I think it's going to be around.
Well, while you're in Miami, make sure to give the mayor a hard time about his Miami specific crypto that went bust after promoting that heavily last year. And the audience can't tell, this is Jim's effort in kind of setting up his post TMC plans, and that's to take over the crypto and meta universes.
Well, I'm not sure about taking over. I just want to be transported to places and that I want to experience without having to fly. I'm getting tired of flying. So.
Well, fair enough. Well, Rob, Have an amazing time tomorrow night at MSG, and say hello to Max Weinberg, the rest of the E Street Band, and the boss himself. And Jim David, thank you again. Audience, be sure to pull some pranks on your friends this weekend. And hope everybody has a great weekend in store.
Thank you, Tom, and thanks for doing a great job on this.
Yeah.
Great
Rob?
job, Tom. And
Mhm.
Rob, thanks for lending your your brain and name to this event. We really appreciate it.
Yeah, you guys.
And
make
I
it
guess
look good.
we'll call you Parrot Head from now on. But
No,
you know,
no. All right. Adios, guys.
Have a good
all right,
weekend, everyone.
guys. Thank you. Bye.